All right, good afternoon. My name is Jake Heitkamp. I'm an analyst at FR Risk Management, and today I'd like to give you a brief overview of the 2018 proxy proposals for ARC NYC REIT. First, I'd like to provide a brief backdrop regarding the program and some recent events that have transpired, and then we'll go over some of the 2018 proposals along with our recommendation. In April 2014, ARC New York City REIT became effective. Its IPO closed in 2015. It was fully subscribed and they raised just over $750 million. This occurred notably before the RCS proxy fraud issues in late 2015. ARC NYC deployed offering proceeds by constructing a portfolio of 6 buildings located in New York City, 3 of which are located in Midtown Manhattan, 1 on the Upper East Side, 1 on the Upper West Side, and 1 down by Wall Street. These properties are mixed-use office and retail with current occupancy of approximately 88%, with a weighted average remaining lease term of approximately 6.2 years. Acquisitions took place between 2014 and June of 2016. In October 2017, the board approved an estimated NAV per share of $20.26. And as of June 30th, 2017, this was below the NAV per share estimated at $21.25 as of June 30th, 2016, and notably below the $25 offering price per share. Leverage on the portfolio is relatively modest at approximately 31% debt to gross properties, providing a runway for further levering of the portfolio to acquire additional properties, given that the equity raise and the initial equity raise is over. This is likely the only avenue remaining for the portfolio to expand. 4 of the properties are unencumbered and the remaining 2 have fixed mortgages on them. Finally, in 2017, the share repurchase program was amended to authorize repurchases solely for death or disability of the stockholder. Let's take a look at some of the distributions on ARC NYC. Since inception, distributions to shareholders have dwarfed operating cash flow and funds from operations. This slide presents cumulative distributions, FFO and CFFO. As you can see, cumulative distributions through the end of 2017 have totaled approximately $141 million. Cumulative FFO was approximately $8.8 million, and cash flow from operations have totaled approximately negative $3.7 million. This historical overdistribution has eroded NAV per share significantly. Additionally, in the first quarter of 2018, the board suspended distributions to focus on acquisitions, repositioning of properties, and leasing efforts, and to make capital expenditures on existing properties. ARC NYC noted in a recent investor presentation that the board doesn't anticipate reviewing distribution policy until early 2019. Let's take a look at some recent developments that are key to understanding and providing context to the current proxy proposals and our analysis of them. In 2016 and 2017, ARC NYC's board of directors put forth a slate of proxy proposals seeking charter revisions akin to those sought in the current proxy proposals. The proxy proposals were rejected by shareholders in each instance. However, approximately 36% of outstanding shareholders voted for these provisions in each respective year. In June 2017, Cove Partners urged shareholders to reject the 2017 proxy proposals, describing the proposals as, quote, self-serving and further entrenching of existing management. I think a brief note on Cove is warranted. Cove is led by Michael Ashner, who is the CEO of Winthrop Realty Trust, which currently is in liquidation, and previously went activist on the publicly traded New York REIT Inc., a formerly AR Global sponsored investment program that trades under the NYRT ticker and has a similar investment portfolio to ARC NYC. Ashner's firm Winthrop Advisors was appointed by NYRT's board to serve as external advisor to NYRT in 2016. Their term as advisor began in March 2017, ousting the previous advisor, which was affiliated with AR Global. This led to a change in key management personnel and to the addition of new board members at NYRT. Note that NYRT is currently executing a plan of liquidation adopted in early 2017 and recently announced on May 1st a liquidating distribution of $4.85 per share following the sale of certain portfolio properties. How does this matter to ARC NYC? Mr. Ashner is affiliated with the advisor liquidating NYRT and has objected to ARC NYC's 2017 proxy proposals through his investment in Cove Partners, which owns 100 shares in ARC NYC. In the first quarter of 2018, ARC NYC entered into a settlement agreement with Cove. The terms of the settlement agreement include that Cove would not engage in any solicitation of proxies or consents or seek to call a special meeting of stockholders or otherwise communicate opposition to any proposals made by ARC NYC or its board of directors regarding election of directors or proposals to amend ARC NYC's charter. Further, Cove is barred from seeking representation on the board, instituting certain undisclosed but presumably derivative litigation against ARC NYC, and to advise, support, influence, or knowingly encourage any shareholder to vote in opposition to any action recommended by ARC NYC's board. ARC NYC disclosed in the same filing announcing the settlement agreement that they paid Cove an undisclosed amount for the promises that Cove made in the settlement agreement. ARC NYC indicated that a copy of the settlement agreement will be filed as an exhibit to a future filing, which as of today has not been made available. I expect it will be in the 10-Q for the first quarter or shortly thereafter the May 31st, 2018 annual meeting. Finally, in the fourth quarter of 2017, the board voted to classify itself pursuant to provisions in the MGCL into 3 classes. This staggers the election of directors and effectively limits shareholders' ability to influence the governance of ARC NYC over a short time period. This is typically perceived as a defensive measure to thwart activists in hostile takeover attempts. With that kind of a backdrop of where ARC NYC is now and some of the recent developments, let's look at the 2018 proxy proposals, which for those of you who have been through this before are very similar to the 2016 and 2017 proposals. So Proposal 2A would eliminate charter provisions mandated by NASR REIT guidelines. Some of the protections, right protections that would be eliminated if shareholders were to approve Proposal 2A would include that directors would no longer have a fiduciary duty, the highest duty in law, to the company or shareholders. Instead, this would default to the MGCL standard of good faith in a manner the director reasonably believes to be in the best interests of the company. Second, it would eliminate Article 9 of the Charter, which contains investment limitations, including a prohibition on investing in debts of affiliates that are subordinated to liens or other indebtedness of the affiliate. Third, it would eliminate provisions that limit voting rights on shares issued in private offerings, which could prospectively dilute existing shareholder voting rights. It's important to note that ARC NYC has not made any sort of filings related to any issuance in a private offering, nor has it done so in the past. Fourth, the elimination of protections in a roll-up transaction, including the requirement that in such a transaction, ARC NYC would be required to obtain appraisals on the REIT's assets and the right for shareholders to demand cash in lieu of securities in other entities. Additional rights that would be foregone would include the right of 10% of shareholders to call a special meeting of stockholders. In the absence of this charter provision, the board could increase the threshold through amendment of the bylaws in the absence of this charter provision. Secondly, under the charter, stockholders are entitled to receive the list of stockholders via written request. The elimination of this provision would materially weaken shareholders' ability to coordinate and participate in the governance of ARC NYC. Additional charter revisions that are sought are the elimination of Article 8 from the current charter. Article 8 establishes guidelines for the advisor. Eliminating Article 8 will open the door for a fundamental change in the advisor's relationship with ARC NYC. This would eliminate prohibitions on a multi-year advisory agreement. Note that other REITs under advisory agreements with affiliates of AR Global, including American Finance Trust, now includes ARC Retail Centers of America following a merger, and the publicly traded Global Net Lease under the ticker GNL, currently have 20-year advisory agreements in place. Additionally, Article 8 allows the board currently to terminate the advisory agreement on 60 days written notice for any reason. This is an important provision given that the 20-year advisory agreements in place at American Finance Trust and Global Net Lease only allow for termination for cause or an internalization of the advisor. Article 8 also imposes a fiduciary duty on the advisor to the company and stockholders. It establishes limitations on advisor compensation, including acquisition and disposition fees. A vote in favor of Proposal 2A would strip out all of these valuable protections. Moving along to Proposal 2B. Proposal 2B would eliminate the duration provision. Important, would remove Article 15 from ARC NYC's charter. Important to note that Article 15 does not require the company to adopt a plan of liquidation on the 6th anniversary of the close of the IPO, which would be May of 2021. However, Article 15 requires the board to consider such a plan of liquidation at that point. If the board declines to adopt a plan of liquidation and present the plan for shareholder approval, it requires the board to revisit the issue on an annual basis. I think it is important to keep the board considering these issues regularly, given that this investment program was marketed as a life cycle REIT, and previous investor presentations from ARC NYC have targeted a 2018 to 2021 liquidity event. While there is no demand for liquidation in the article, there is also no harm in requiring the board to consider it annually if a liquidity event has not taken place by 2021. First, it is important to note that other non-traded REITs have sought and received shareholder approval for charter revisions similar to those put forth by ARC NYC in the recent proxy proposals and in the proxy proposals in 2017 and 2016. These proposals aren't completely abnormal in the non-traded REIT space. However, in discussing these matters with many of you in the audience over the past 2 years, there seems to be a consensus that eroding shareholder rights and protections in the absence of a clearly articulated strategic proposal, putting the cart before the horse. Given that such a strategic proposal would require shareholder approval anyways, it makes sense that seeking charter amendments to execute on a strategic proposal could be put forth in the same proxy outlining a prospective strategic proposal. Additionally, to the best of my knowledge, I am not aware of any of the REITs that have obtained shareholder approval for such charter revisions in the past, have instituted a 20-year advisory agreement, or effectively paid off shareholders for silence that oppose carving out the respective charters, as AR Global advised entities have done in recent years. For the foregoing reasons discussed today, I apologize, I missed a couple slides here. This will all be available for you to download it in the future. For the foregoing reasons discussed today, FR Risk Management has determined it would be unwise to concede valuable shareholder protections and rights at this time. Subsequently, opposing the board recommended proxy proposals 2A and 2B would be prudent in our judgment. If the board were to present a specific strategic transaction requiring such charter revisions as contained in the current proxy proposals, perhaps based on the merits of such a prospective transaction, our analysis would be subject to change. Further, given that all of the current members of ARC NYC's board have served in their present roles for a minimum of 2 years, during which time ARC NYC has repeatedly sought the same charter revisions, which shareholders have rejected twice now, and presided over the company paying off a shareholder that publicly opposed charter revisions analogous to the current proposals, FR Risk Management does not think it is prudent for shareholders to continue to vote for the re-election of any of the current board members going forward. With that, I'd like to thank you for listening today. I hope this presentation has been informative and useful for you. And if you'd like to discuss these matters further or have any questions for me or would like to discuss FR Risk Management services for your firm, I'd be happy to speak with you. Be reached at jake@frriskmanagement.com or at 847-805-6245. Thanks again for listening in, and have a great afternoon.